My name is Utpal Bhattacharya, and I'm in the finance department here. My department chair was supposed to be introducing Professor Nicholas Barberis, but he's having meetings, and he asked me to do this. I am very nervous. So I thought I should dress up as much as I can for this introduction. So I went to my wardrobe. I noticed that I had about 12 clean shirts, 8 trousers, 4 pairs of shoes, and 4 jackets. So if I multiply this right, 12 multiplied by 8, multiplied by 4, multiplied by 4, that's 1,536 permutations and combinations. So I decided to be rational and said, well, how long will it take me to compare everything and get dressed? Hours. So I decided not to be rational and became behavioral. So I said, well, let's wear something that I wore a few days ago. And someone said, that's a good dress. So I overweighted something that happened in the recent past. I'm supremely confident that what I'm wearing is correct. But my ego is fragile. If one of you tell me you don't look good, then the pain that you will cause me is much more than the happiness you will cause me if you tell me that I'm looking good. So that's behavioral finance for you. So here we have today, in front of you, one of the leading proponents of behavioral finance in the world, and we are very lucky to have him, Professor Nicholas Barberis. He graduated with a BA in math from Cambridge University, then went to do his PhD in business economics from Harvard University. His first job was at the Chicago Booth School of Business, and then he moved to Yale in 2004, where he is the Stephen and Camille Schramm Professor of Finance. He has published extensively in the top economics and finance journals and given frequent presentations like this to academic and non-academic audiences. He's won numerous teaching awards, the SOM Alumni Association Teaching Award, and he's also won the Jack Trainer Prize in 2014, which is an extremely prestigious prize in our profession. He's a research associate of the National Bureau of Economic Research in the United States and a fellow of the Behavioral Economics Roundtable of the Russell Sage Foundation. Those are his qualifications, but there's one other aspect that I'd like to mention, which I just discovered a few days ago. He's a superb teacher. Last Thursday, I attended a PhD class which he taught, and I was spellbound. It was like an Alfred Hitchcock movie. He is an awesome teacher, and for those of you who are interested to hear him speak once more, he's giving another class to our PhD students tomorrow at 2:30 p.m. I won't talk more. You aren't here to listen to me, so I'll give the mic over to Professor Barberis.
And thank you also to the Institute for Advanced Study and Department of Finance here at the university. I've very much been enjoying my visit, and I appreciate this opportunity very much. I'd like to talk to you today about my area of research, behavioral finance. I'm not going to talk for very long, and I hope to leave plenty of time afterwards for any questions, comments, thoughts, or reactions you might have. I'd be very interested to hear them. So I think many of you know that the modern research era in finance started in the 1950s, and from the 1950s to the 1990s, finance research was really dominated by a single framework that was often called the rational agent framework. And it was called that for good reason, because it basically assumed that every market participant is fully rational. And that's a useful and important framework. But by the 1990s, it had become clear that many important facts in finance don't fit very neatly into this framework. And so starting in the 1990s, a second framework emerged, the behavioral finance framework. And what this tries to do is to make sense of financial phenomena using models where some people are not fully rational. And it advocates reading the psychology literature carefully to understand the ways in which people are not fully rational, particularly the work of Daniel Kahneman and Amos Tversky. But more broadly, what this field is trying to do is to make sense of financial phenomena using models that are psychologically more realistic. There's a sense that the models we were using for decades just aren't psychologically realistic enough to capture even basic things about financial markets, and we need models that are psychologically more realistic. And I think over the past 20 years, behavioral finance has really developed very rapidly. It's now a large mainstream part of financial economics. I think that on some dimensions, the field has been successful. As I'll try to persuade you today, I think it explains observed facts in simple, intuitive ways. It makes testable predictions, at least some of which have been confirmed in the data. It has aroused strong interest, not just among academics, but among practitioners and policymakers as well. It's done well in terms of citations. Many of the most cited young financial economists work in this area, and numerous prizes have also been given for research in the field. But I think it also still has a long way to go, and one particular goal that we might have is that all active finance researchers be familiar with the core ideas in the field and apply them as appropriate. And we're not there yet, and I view my task a little bit as trying to convey what these core ideas are. And with that in mind, what I thought I might do today to be useful is to pick out 3 ideas from behavioral finance that I think are particularly helpful for making sense of the world. And I'm thinking of the 3 ideas I picked out, rather, are over-extrapolation of the past, overconfidence, and prospect theory. And what I'm going to try and show you today is that these 3 ideas can really further our understanding of many important financial phenomena, including asset market fluctuations, the performance of investment strategies, bubbles, trading volume, and acquisition activity. And at the end, I'll just close with some broad remarks about progress in the field. And I should emphasize that everything I'm going to say today is backed up by formal research, either by mathematical models or by analysis of empirical data, but I'm mainly going to try to focus on conveying the intuition today. All right, so let's take the first idea, over-extrapolation. This is the idea that when people form beliefs about the future, they put too much weight on the recent past. And you can apply this idea either to economic fundamentals or to returns. For example, if recent economic fundamentals have been good, people are too quick to think that future fundamentals will be good as well. If recent economic fundamentals have been bad, people are too quick to think that future fundamentals will be bad. But you can also apply it to returns. If the recent returns on an asset class, or a fund have been good, people are too quick to think that the future returns will be good. If the returns have been bad, people are too quick to think that the future returns will also be bad. Today I'm going to focus more on extrapolation of returns, specifically models where some investors' beliefs about future price changes are a weighted average of past price changes. So if you will allow me just one equation today, I'm going to be interested in models where some investors form beliefs like this. Their expectation at time t of the future price change on the asset is a weighted average of past price changes with more weight on more recent past price changes. So here theta is something between 0 and 1, so you're putting more weight on more recent past price changes. And return extrapolation, the idea embodied in this equation, is an old idea. You can find it in qualitative accounts of financial markets going back decades. There was a first wave of formal research on this topic in the 1990s, and recently there's been a second wave of research. It's quite an active topic, spurred, I think, by renewed attention to an interesting kind of data, namely survey data. So there are many surveys out there that ask investors, both individual and institutional, for their forecasts of future stock market returns. For example, what is the return you expect on the stock market over the next year? And these data, first of all, provide evidence of extrapolation. If the stock market has recently done well, people think it's going to do well in the future. If it has recently done poorly, people think it's going to do poorly. And you can see that in the figure at the bottom. This is specifically the Gallup survey running from about 1996 through to 2012. The red line is in each quarter people's expectation of how the stock market is going to do over the next year. And the blue line is at that moment in time how the stock market did over the previous year. And you can see just by eyeballing it a high correlation between the two lines. If the stock market has recently done well, people think it's going to keep doing well. If it's recently done poorly, people think it's going to keep doing poorly. But these data also provide evidence of over-extrapolation because the beliefs you see here are incorrect. If you look at the correlation between people's expectations of how the stock market is going to do and how it subsequently actually does, you see a negative correlation. When people think the market's going to do well, it actually does poorly. When they think it's going to do poorly, it actually does well. So it's renewed attention to data like these that I think has spurred renewed attention to this topic of over-extrapolation. And so what I'd like to show you today is that models in which some investors extrapolate past returns, where their beliefs about future returns are a weighted average of past returns, can explain several of the most important facts about asset prices. And I've picked out in particular momentum and reversals, time series predictability, and bubbles. And I don't want to assume that you all necessarily know what these facts are about, so let me briefly review them. So momentum and reversals first. So the prices of individual stocks exhibit what is called medium-term momentum. Stocks with high past 6-month returns have higher subsequent returns on average than stocks with low past 6-month returns. So perhaps I can clarify a little bit by just doing a simple sketch on the side here. If at any moment in time you rank all stocks in your database based on their performance over the past 6 months, you have some big winners and some big losers. It's interesting to then ask, how do these two groups of stocks do over the next 6 months? And what we found over many decades of US data, but also most international market data, is that these prior winners subsequently continue to do quite well, while the prior losers subsequently do quite poorly. That's medium-term momentum. But there's also long-term reversals. Stocks with high past 3-year returns have lower subsequent returns on average than stocks with low past 3-year returns. So if I draw the same picture here, at any moment in time, you might rank stocks based on their performance over the past 3 years. So you have some big winners and some big losers. And it's interesting to ask, how do these two groups of stocks do in the future? And what we found over many decades of data is that these long-term past winners subsequently do poorly, while the long-term prior losers subsequently do well. So that's momentum and reversals, an important fact we're trying to understand. Second fact, time series predictability. So the price to earnings ratio of the aggregate US stock market negatively predicts the market's subsequent return in the time series. In other words, the stock market is not a random walk. Its future return can be predicted to some extent in advance, for example, using the price to earnings ratio. So in this picture, every number is a year over the past few decades. The horizontal axis is the price to earnings ratio of the stock market in that year, and the vertical axis is the subsequent 10-year price growth of the stock market. And you can see the negative relationship. In years with high price to earnings ratios, we subsequently see lower returns. In years with low price to earnings ratios, we subsequently see higher returns. So that's another thing we're trying to understand. And finally, we're trying to understand bubbles, which are, of course, episodes where the price of an asset rises dramatically and then collapses. And during the price rise, there's much talk of possible overvaluation and high volume. And a classic example is the technology bubble in the United States in the late 1990s. This picture showing you the dramatic rise of technology stocks and then fall as compared to just the S&P 500. So those are important facts about asset prices, and what I'd like to persuade you of is that models where some investors extrapolate past returns, where their beliefs about future returns are a weighted average of past returns, can explain these facts. And maybe to make this as clear as possible, maybe I can get some help and use the document camera just briefly. So thank you very much. So let's see. Let's take some period of time with 5 dates. And imagine that on the second date here, there is strong positive cash flow news, strong news about the future fundamentals of an asset. And what I want to show you is how the price of the asset will behave in an economy where some people extrapolate past returns. So specifically what will happen is this. The price of the asset will start here. Then, of course, it will rise sharply when the good cash flow news comes out. But then here's what happens. At the next date, extrapolators looking back see positive past returns, which makes them think that future returns will be good, so they buy the asset aggressively, pushing its price even further up. At the next date, extrapolators look back and they see high past returns, so that makes them even more bullish about the future, leading them to push the asset even further up. But here's the key point. At some point, the price of the asset will collapse like this. And the reason that that is happening is that at some point, the really good past price change, this one over here, associated with the really good cash flow news, it recedes further back into the past and therefore receives less weight in extrapolators' beliefs. Therefore, they become less bullish and the price falls. And this picture, I think, shows you how this model can explain all of the facts that we talked about a few minutes ago. So first of all, here at the beginning, you can see the medium-term momentum. Notice how the good return is followed by more good returns. And the intuition is if an asset has good returns, then the extrapolators looking back now seeing the good past return now think that the future return will be good. Therefore, they buy aggressively, pushing the asset even further up. You can see the long-term reversals, right? Notice how the good long-term past return is followed by poor returns. The intuition is that if an asset has good long-term returns, that's a sign that extrapolators have been buying it aggressively, causing it to become overvalued, and an overvaluation is followed by a correction. You can see the time series predictability, right? Over here, prices are high relative to earnings, and you can see that high price to earnings ratio is followed by low returns. The intuition is that a high price to earnings ratio is a sign that extrapolators have been aggressively buying the asset, causing it to become overvalued, and the overvaluation is followed by a correction or low returns. And finally, if the cash flow news is sufficiently strong, this hump shape is going to be particularly pronounced, and that's going to look something like a bubble. And so the theory of bubbles here is really the one that people like Kindleberger proposed, which is that a bubble is formed when there is strong cash flow news, strong positive news about fundamentals that pushes the price of the asset up. Extrapolators seeing that then immediately think that future returns will be good, so they aggressively buy the asset, causing it to rise even further in the short term. And by the way, notice here that the extrapolators do okay at some points in the cycle. So for example, here they're buying aggressively, and that's okay. In the next period, they make some profit. But generally, the extrapolators don't do well. Generally, they lose money. Over here, they're buying aggressively, but they then lose a lot of money because of the correction. So I hope that sort of helps explain how this simple idea that people sort of extrapolate past returns can explain a lot of these important basic facts about asset prices, momentum and reversals, time series predictability, and bubbles. It's really sort of striking to me that a simple assumption like that can make sense of a lot of what we're trying to understand in the field of asset prices. Now, I should just say there's many important open questions here. Like a very open question we don't know the answer to is, why do investors extrapolate past returns in this way when forming beliefs? I don't know the answer to that question. Perhaps someone here at the end will have some nice ideas about that. One hypothesis that's been proposed is that it stems from something called the representativeness heuristic, which is a famous idea of Kahneman and Tversky. Basically, what this idea says is that if the data reflect the essential characteristics of some model, people will be too quick to embrace the model. And the mistake they'll be making is they're neglecting the base rate, in other words, the unconditional likelihood of the model. So, for example, if I tell you that someone is shy and reserved, and then I ask you whether this person is more likely to be a librarian or a lawyer, most people say librarian. And we think that they're using the representativeness heuristic. The description reflects the essential characteristics of a librarian. But still, there's a mistake here. People are neglecting the base rate. There's forgetting that there's far fewer librarians in the population than lawyers. So even though it sounds like a librarian, it's actually still probably more likely to be a lawyer. And so people have applied that argument in this context. If an asset has high returns over some period, people may be too quick to think that the true mean return of the asset is high. Because of the representativeness heuristic, after all, the data reflect the essential characteristics of an asset with a high true mean return, namely high realized returns. But still, there's probably a mistake there. People are forgetting that it's relatively rare for an asset to have a high true mean return. So even if the data reflect the characteristics of such an asset, probably it actually doesn't have a high true mean return, and therefore it's a mistake to extrapolate its past returns into the future. So that was the first big idea for today, over-extrapolation of the past. So the second idea is overconfidence, and overconfidence is a broad idea. I just wanted to mention a couple of common manifestations of overconfidence. So one of them is something called overplacement. People tend to have overly rosy views of their abilities relative to other people. And this is the thing most easily established in those surveys, right, where at least 80% of people believe themselves to be above the median on various dimensions like attractiveness or sense of humor or ability to get along with people or driving ability. We all think we're above average, but obviously that's not possible, so many of us must be deluding ourselves. A second type of overconfidence is overprecision. People tend to be too confident in the accuracy of their beliefs. And this is established by asking people for confidence intervals. So I might ask you to estimate some quantity, for example, the number of gas stations in the US state of Connecticut, but not only to give me an estimate, but also a 90% confidence interval, so that you're 90% sure that the right answer falls in that interval. And then I might ask you many such questions and see how often the right answer falls into the interval. If you're correctly calibrated, then the right answer should fall into the interval 90% of the time. But most studies find that the right answer falls into the interval around 50% of the time, indicating that the confidence interval is too narrow and suggesting that people are too confident in the precision of their original estimate. So a big motivation for thinking about overconfidence in the financial context is the very high trading volume we observe every day in financial markets. And there's a growing sense that to make sense of this very high trading volume, we might need to appeal to something like overconfidence. And to make that argument, I want to start with a narrower manifestation of high volume, specifically excessive trading by individual investors, and then I'll broaden the argument out. So in academia, we've done a pretty good job of getting hold of large databases of how ordinary people trade stocks. There's one particularly famous database of around 70,000 households trading stocks through a large US discount brokerage firm in the early years of the 1990s. We've learned a lot from these data, and one basic thing we've learned from these data is people don't do a good job trading stocks. Their average return underperforms a range of benchmarks. And you can see this in this picture. So let's see, the second black column from the right, this is the average return of the typical household trading stocks through this brokerage firm after transaction costs. And the rightmost column is the average return of a passive benchmark like the S&P 500, again after transaction costs. And you can see the typical household underperforming by 1 or 2% per year, which is really a substantial amount that can add up over time. Moreover, the people who trade the most do the worst. So on the left, the authors have put people into 5 buckets, 1 through 5, based on how much they trade. Bucket 1 is the people who trade the least. Bucket 5 is the people who trade the most. And if you look at the black columns, their average returns after transaction costs, you can see a big decline in performance the more people trade. And I think this picture is difficult to understand on fully rational grounds. Why would people trade so much when it's hurting their performance to the extent that it is? But people have proposed that overconfidence offers a nice explanation of what's going on here. So the idea is that an investor may know that the typical household trading through the brokerage firm underperforms, but this investor believes that he or she is better than all of the other investors at picking stocks. So they go ahead and they trade. But because they're probably overconfident, because they're probably overestimating their stock picking ability, they underperform just like everyone else. So we want to be scientific about this, right? We want to test this hypothesis. So what's a prediction we could test? I think a natural prediction is more overconfident people will trade more because they're so sure they know what they're doing. And what's happened is there have been some nice empirical studies testing that hypothesis. I'll mention just one of them by Grimblatt and Kelahaju. I think Matti Kelahaju is actually visiting the department this week. So this study and others use data from Finland or Sweden. A lot of these studies use data from those countries because those countries keep very detailed records of what their citizens do. So the challenge here is to figure out who in Finland is more overconfident. So here's how they do it. It turns out that at the age of 18 or 19, every Finnish male goes into the military. And when you do so, you take a bunch of tests, some psychological tests and some aptitude tests, some tests of math and verbal ability. One of the psychological tests is a self-reported measure of confidence. How confident are you on a scale from 1 to 10? And so the measure of overconfidence in this study is people's self-reported confidence minus how confident they should be based on their performance in the aptitude test. So it's a little bit cruel, but it's good, right? Good measure of overconfidence. And the remarkable finding in this study is that that measure of overconfidence measured at the age of 18 or 19 predicts the frequency with which people trade stocks several years later when they finally open a brokerage account of their own. So I think that's nice evidence showing a link between overconfidence and excessive trading. But as promised, let me try to broaden the argument out a little bit. There's a growing sense these days that in order to understand the high overall trading volume in financial markets, we may need to appeal to something like overconfidence. Why do I say that? Because if you write down models where all investors are fully rational, these models typically don't predict a lot of trading. And I've written here that's because each investor infers a negative signal from others' willingness to trade, and this reduces her own willingness to trade. So to put that simply, what happens is I go to buy a stock and then I find that you're willing to sell to me, but then immediately I'm going to say, wait, why are you willing to sell to me? You know something bad about the future prospects of this stock. So therefore, perhaps I shouldn't buy. Now that may sound extreme to you, but that is how a fully rational individual will think. And therefore, these models don't tend to generate a lot of trading volume. But overconfidence offers an appealing way out of this logjam, I think. Under the overconfidence view, what happens is that each investor overestimates the precision of her analysis and underestimates the precision of others' analyses, and heavy trading follows. So just to repeat the story to make that clear, in this case, I go to buy a stock, you're willing to sell to me, So immediately I say, okay, why are you willing to sell to me? Okay, you think you know something bad about the future prospects of the stock. But then immediately I say, I don't care what you think, because I think I'm much better than you at analyzing stocks. And you feel the same way about me, and therefore we're quite happy to trade. So notice how overconfidence can naturally generate a lot of trading volume. So it's quite interesting to me that something as fundamental as trading volume, ideas from behavioral finance like overconfidence might be quite helpful in making sense of that. By the way, let me give you one other interesting application of overconfidence, perhaps involving even larger sums of money, excessive volume of M&A activity. So one long-standing question in finance is, why are there so many acquisitions when there is little evidence that they create value for the acquirer on average? On average, the stock of the bidding company underperforms over the 3 years after the acquisition event relative to a control group of firms, raising the question of why are firms so keen to acquire one another when on average this doesn't add value to the acquirer. So this is a long-standing question, and there's a number of possible hypotheses, but one of them is overconfidence, specifically CEO overconfidence. And the story is a CEO may know that the typical acquisition doesn't go very well, but he or she believes that they're better than all of the other CEOs and can make this acquisition work, even though acquisitions typically don't go very well. Therefore, they go ahead and they do the acquisition, but because they're overconfident, they end up messing it up, just like everyone else. And some people attribute this hypothesis actually to Warren Buffett. There's a famous paragraph in a 1981 annual report of his that puts forward this hypothesis. Perhaps you've seen this paragraph before, it's quite well known. Many managements were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they're certain their managerial kiss will do wonders for the profitability of the target company. We've observed many kisses, but very few miracles. Nevertheless, many managerial princesses remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. So he puts it very well. You want to believe it just on the basis of that paragraph, but we need to be scientific about this, right? We need to test this hypothesis. And what's a natural prediction to test? I think a natural prediction is that more overconfident CEOs will do more acquisitions because they're so sure they know what they're doing. And there's a well-known study that tried to test exactly that prediction. The trick, of course, is figuring out which CEOs are overconfident. And the way the study does it is it identifies CEOs as overconfident if they hold on to their executive stock options longer than recommended by standard models of option exercise. So as you know, CEOs are often compensated with stock options, and there are models that tell the CEOs when they should exercise the stock options for optimal diversification and so on. And what this study is doing is it's identifying the CEO as overconfident if they hold on to their stock options longer than recommended by the model. The thinking is that this is a CEO who believes that they can grow their firm even more and that they're going to make more money by exercising the stock options later. And you can check that they are overconfident rather than just confident, because on average they lose money by exercising the stock options later than recommended. And so with that measure of overconfidence in hand, the striking finding in this study is that these managers identified as overconfident do indeed do more acquisitions, particularly the most value-destroying kind of acquisition, so-called diversifying acquisitions, where you buy firms in other industries, and the market reacts more negatively to acquisition announcements from these managers, as if to say, oh no, it's that overconfident person again with their acquisition, which is bound to fail. And just in case you're not fully convinced by this as a measure of overconfidence, the authors also tried to measure overconfidence in a different way. So what they did is for each CEO, they gathered all the newspaper articles that had been written about the CEO, and based on the adjectives that journalists used to describe the CEO, they categorized the CEO as either overconfident or not. And based on that measure of overconfidence, they actually got rather similar results. So it's quite striking to me that even in these huge financial transactions, ideas from behavioral finance might be quite helpful for thinking about the facts. So that brings me to the third and final idea, specifically prospect theory, which is a famous idea of Daniel Kahneman and Amos Tversky. It's specifically a prominent model of how people think about risk and is viewed by many psychologists as the best available summary of individual risk attitudes. It has a number of features, but let me emphasize just two today. So one feature is loss aversion. It's the idea that when people are judging some risk that they face, they think in terms of the potential gains and losses in wealth going forward, and they're much more sensitive to the potential losses than to the potential gain. But also I'd like to emphasize another feature known as probability weighting, which is that people tend to process probabilities in a non-linear way, in particular overweighting low probability outcomes. So here's a famous picture of this. On the horizontal axis is the objective probability of the event, and on the vertical axis, with the solid shown in the solid line, is the weight that the brain puts on an outcome with that probability, relative to what you might consider the rational benchmark, which is the 45-degree dashed line. And so you can see the non-linear way in which the brain weights probabilities, and in particular the overweighting of low probability outcomes over here on the left. And this picture is based on extensive experimental evidence, but one simple way of motivating this overweighting of low probability outcomes is just from the fact that human beings like both lottery tickets and insurance policies. And the overweighting of low probability outcomes is a simple way of capturing that behavior. If people overweight the low chance of winning the jackpot, they're going to love lottery tickets. But if they also overweight the low chance of disaster, they're going to like insurance policies. So loss aversion is the best known feature of prospect theory probably, but actually at this point my sense is that probability weighting has more applications in finance. And perhaps this shouldn't be so surprising. After all, probabilities are central in finance, and the way the brain reacts to probabilities is surely central. So perhaps it's not surprising that probability weighting has a lot of applications. So here's an example. A simple prediction that probability weighting makes is that the skewness of an asset's returns will be priced, even idiosyncratic skewness that is unrelated to broader market movements. Specifically, positively skewed assets will get overpriced and will therefore earn low average returns going forward, while negatively skewed assets will be underpriced and therefore earn high average returns going forward. So the precise intuition for this depends a little bit on the model, but the simplest version of the intuition might be something like this. So if you have a positively skewed asset, its return distribution looks a little bit like this. It has a long right tail. This is an asset that offers a small chance of an incredibly good outcome. And I'm saying that under probability weighting, something like that will get overpriced. Why? Because the brain is going to be overweighting these low probability right tail outcomes. So you find this asset very attractive, you're willing to pay a lot of money for it, and to accept a low average return on it. Negatively skewed assets are the opposite. They have a long left tail. The return distribution is like that. They involve a small chance of a really bad outcome. I'm saying such assets will get underpriced, and the logic is the brain will overweight the low probability outcomes in the left tail, therefore such an asset is very scary. It will be underpriced and therefore offer high average returns. And that simple prediction, I think, can help us make sense of a lot of facts, specifically facts about average returns on asset classes. There's lots of puzzles here. Some average returns on asset classes are surprisingly high. For example, the equity premium on the aggregate US stock market. Over the past 2 centuries, the US stock market has outperformed treasury bills by a huge margin. Now, of course, the stock market should have a higher average return than treasury bills. It's riskier and therefore should offer a higher average return to compensate. But what's puzzling is the extent of the outperformance. Other average returns, meanwhile, are puzzlingly low. So here is a very interesting fact. The average return on IPO stocks in the 5 years after issue is surprisingly low. Here's a famous study of this. The 5 columns in the front row show you the return on IPO stocks in the 5 years after the IPO, on average. And the columns in the back row show you the returns of a control group of stocks. Stocks that are similar to the IPO stocks but did their IPO much further back. And you can see the much lower average returns for the IPO stocks. And I just want to point out that probability weighting offers a simple framework for understanding both of these facts. First of all, notice that the aggregate stock market has negatively skewed returns. It's like the lower of the two pictures I drew over here. The stock market as a whole is subject to occasional large crashes. So under probability weighting, it therefore should indeed have a high average return. And the intuition is that the brain is overweighting the low probability outcome whereby there's a big market crash. Therefore, you find the stock market as a whole quite scary and it earns a high average return. Conversely, IPO stocks have positively skewed returns. They're like the upper of the two diagrams over here. Most IPOs, when you buy them, they don't really go anywhere, but some, like Google or Microsoft, do incredibly well. IPOs have positively skewed returns, but then under probability weighting, they should have a low average return. And the intuition, again, is that when you buy an IPO, you're overweighting the event that this will turn out to be the next Google. Therefore, you're willing to pay a lot for the IPO and to accept a low average return on it. And this idea that positively skewed assets should have low average returns, it has lots of other applications. If you look at the average returns of distressed stocks, bankrupt stocks, stocks traded in over-the-counter markets, if you look at the returns of out-of-the-money options on individual stocks, if you look at the returns of stocks with high volatility, the average returns on all of these asset classes is very low, which is a puzzle. But what's interesting is all of these asset classes also have highly positively skewed returns. They're all basically like lottery tickets. And therefore, probability weighting says, indeed, they should have low average returns. So that's an interesting hypothesis that people are examining. All right, so in my effort to sort of be helpful today, I thought that what I would do is pick out 3 ideas from behavioral finance that I think are particularly useful. And after thinking about it a bit, I picked out these 3 ideas: over-extrapolation of the past, overconfidence, and prospect theory. And I hope I've given you some sense of how these ideas can help us make sense of many important financial phenomena. We've talked about asset market fluctuations, the performance of investment strategies, bubbles, trading volume, and M&A activity. And I hope you agree that a lot of the explanations we considered really are quite sort of simple and intuitive. So just a couple of sort of closing remarks. In the 1990s, when behavioral finance got going, people worried about a lack of discipline in the field. So they worried that in behavioral finance we might be doing the following: that any time there was any kind of puzzle in financial markets, what we would do is sort of flip through the psychology book until we came across some psychological bias that would seem to explain the puzzle we were trying to explain, and then declare victory. And there was a concern that we would have a profusion of psychological hypotheses, 30 different psychological biases to explain 30 different facts, which wouldn't, of course, be very satisfying. But the thing I want to point out is that has not happened. This concern has turned out to be completely unfounded. Back when behavioral finance got going in the 1990s, the center of gravity in the field was really in 3 ideas: over-extrapolation, overconfidence, and prospect theory. And now, 25 years later, the center of gravity in the field really remains in those 3 ideas. I'm not sure why we've stuck close to those 3 ideas. It could be that researchers are worried about the lack of discipline problem and are therefore wary of straying from these core ideas. Another possibility is that these ideas really are the most natural ideas from psychology to be using when thinking about financial markets, and so we've just stuck to them over time. Even though we've remained with these 3 ideas, of course, we've learned a huge amount about them. And it's too early really to be talking about what the eventual unified theory of behavioral finance would look like, but if you pressed me to speculate, I think that extrapolation and aspects of prospect theory in particular would be promising building blocks for such a unified theory. And back in the 1990s, when behavioral finance got going, it was quite a controversial field, as new paradigms often are. And there were often actually explicit sort of debates set up between advocates of the rational view and advocates of the behavioral view. And for people who were present at the time, I think those debates were fairly entertaining, but I honestly don't think they were scientifically that useful. Instead, to the extent that behavioral finance has made progress and been successful, I think it has done so by stopping these explicit debates with the rational side and instead sort of coming home, developing models based on its ideas, showing that these models have broad explanatory power and that they make testable predictions that have often found confirmation in the data. I think that's why the field has been successful, if it has been at all. And I think, frankly, that's the process that will continue over the next few years with, I hope, continued success for the field. Let me stop there. Thank you very much.